Good morning. It's Thursday, the 20th of June, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's financial capital. Now, there is a disconnect in the economy, and we've been referring to it indirectly, but we should take note. Inflation is reaching unbearable levels for many people in the country, notably food inflation. Vegetable inflation, as we've been pointing out, is now running at 27%, and heat waves are making it worse, and we will come to that shortly. And then there is Russian oil. Before that, the stock markets are, of course, hovering around their all-time highs. Now, this is not to say that there's something inherently wrong in the stock markets doing well, but to point out that there is a disconnect between some aspects of the economy, and as an investor, you should be advised of this. By the way derivatives markets are booming, it's surely a cause of concern. The Reserve Bank of India Governor Shaktikanta Das on Tuesday said the volumes in the futures and options markets were very large, perhaps even larger than the nominal gross domestic product. He said that they had discussed the matter with the Securities and Exchange Board of India and they were dealing with it. And he said this at an ET Now event. Now back to the real world. One thing that will increase the pressure on the overall macros is oil prices. Oil prices are high now, just under $86 a barrel. But that's not the key problem. The problem is that we as India have been able to buy Russian crude at discounts as high as $16 a barrel since the middle of 2022 or thereabouts. Now, this happened after Russia invaded Ukraine in February 22 and Western nations imposed sanctions on Russian oil exports. Now, India moved tactically and out of self-interest and decided to buy and did buy oil cheaper, which worked out very well for the economy. But that dream run is now ending. Discounts are now down to $3 a barrel or so. Now, some 85% of all our crude requirement is imported. Of that, about 36% comes from Russia right now. That could, of course, change. But overall prices will rise and the government will have a tightrope walk. So the point is that there are more pressure points ahead in the economy, and while the stock markets are riding on strong sentiment and flows, the companies that make up the indices or the stock markets as a whole cannot forever fight rising input prices, nor can savers or investors continue to pump the same amount of money into the markets if their household bills keep rising in the manner they are. And now our top stories and themes for the day. The stock markets stay near highs. Why? The action is now shifting to debt flows. India's dream run with discounted Russian oil is ending, and what that means. Why tenants across India are refusing to let out some 10 million homes, leading to supply distortions. And heat waves are on, affecting food and vegetables, understanding its impact.
This is the Core Report with Govindraj Ethiraj.
The stock markets stay on fresh highs, the action shifts to debt. The stock markets lost traction and fell towards the end of trading on Wednesday, the 19th of June. And of course, the Sensex and Nifty clocked fresh record highs on Wednesday. This, of course, is the same story almost every day. The Sensex hit an all-time high of 77,852 in intraday trade, ending 36 points higher at about 77,337, while the Nifty50 was down 42 points at 23,506. That's after hitting a record high of 23,664. So to repeat, it ended at 23,516. In general, banks were the big gainers, and the major ones like Axis, HDFC, Kotak and ICICI rose between 1 and 3% according to Business Standard. Now, the supply of funds continues to be strong and foreign institutional investors are back in the market, something the core report had been projecting and predicting in the somewhat nervous phase of elections, if you still remember that. And of course, now FIIs have been net positive buyers in the last few trading sessions. The action is shifting to bonds. Foreign inflows into Indian bonds could hit a decade high of $2 billion around June 28th, when they will be included in a widely tracked JPMorgan index. Although the central bank will lap up most of the dollars to avoid a knee-jerk rise in the rupee, bankers told Bloomberg. The $2 billion single-day inflow estimate by 4 bankers to Bloomberg trails only the record high $2.7 billion poured into Indian bonds on August 20th, 2014. That's 10 years ago, as prospects of a credit rating upgrade was gaining traction. Bankers told Bloomberg that it's just a case of inflows, this time in debt instead of equities. And it might be positive for the rupee and it might be positive for foreign exchange reserves as well, which are, of course, near highs. However, based on how portfolio flows related to equity rebalancings happen, the money will come in or on 27th or 28th of June, those bankers told Bloomberg. Now, back on Wall Street, The S&P 500 also rose to a fresh record on Tuesday as AI darling Nvidia continued its march to new highs, topping Microsoft as the most valuable company, CNBC reported, adding that the broad market index closed at about 5,487. The Nasdaq Composite also ended up at a record high at 17,862. The Dow Jones, meanwhile, closed at 38,834. Nvidia has now jumped 3.5% to surpass Microsoft as the most valuable public company, I guess, on earth, and continues its milestone run after topping a $3 trillion market cap, according to CNBC, which also said Nvidia has now surged 174% since the start of the year. Now, there are increasing noises across the board of a bubble and similarities with the dot-com boom of the 2000s, something that we don't talk about much today, but we will talk about that tomorrow. Thank you for listening and your support for the Core Report. We've been streaming for a year, and we think this is a good time and ripe for a quick feedback from you on what we can do new and better on this podcast. And thank you, as always, for some good critical feedback. The link to a short survey is in the show notes. Inflation is rising and heat waves are a concern. India is battling extreme weather ranging from severe heat waves, landslides and floods, killing at least 11 people this week, Reuters is reporting, adding that Delhi, the capital, suffered its hottest night in 6 years on Tuesday. Hospitals in New Delhi reported at least 5 deaths from heat stroke this week, the Times of India said. More than twice the number of heat waves have been recorded in India's northwest and east already. Heat waves will also be putting pressure on food prices in coming months, with pulses inflation remaining in double digits, according to economists. All forms of food inflation, from vegetables to pulses, are rising now. Vegetable inflation, as we mentioned earlier as well, is now running at about 27% and shows no signs of relenting immediately. Pulses inflation is also up at about 17%, that's your dals, compared to 16.8% last month. I reached out to Jasrai, senior analyst at India Ratings and Research, and I began by asking him how he was seeing the impact of heat waves and shifting weather patterns on food inflation right now and his outlook for the next month or so.
Food inflation especially has been very disturbing to the overall disinflationary trend for the overall macroeconomic situation. If you look specifically, food inflation has been above 8% for quite over 7 months. And that is something which definitely impacts the poor, because the poor have a very high amount of share of food items in their overall consumption basket. And that puts less money in their pocket for non-discretionary item expenditure. And if you look at within the food inflation, then specifically vegetable inflation and pulses inflation are the two big pinpoints where the inflation has been above almost very steep at about above 20% for vegetables and above 10% for pulses for about over 12 months. So that has been the kind of, and that is despite government taking quite a bit of measures as well in the past few months. And we expect that to continue even in June as well, because if you look at the recent price data which is released by the Department of Consumer Affairs, then there also high amount of inflation in tomato, onion and potato, all the major vegetables. There again, the inflation remains in high double digits, and so is the case for pulses. So we broadly see that food inflation would be above 8% again in June, and that would be having some impact, definitely not helping the overall retail inflation to go below the 4%, which is the target, the central.
Just to come back to food, now, are we able to see what the specific impact of changing weather is, or is it because we are already seeing a linear growth in food inflation, then we are able to compute forward?
Especially on food inflation, is getting reflected in the way how your overall vegetable and pulses prices are moving around. And because these are more of the perishable items where the supply chain is very, very delicate, and that gets disrupted very easily because of the supply side shock. But the key thing to notice that, especially once the monsoon, as the IMD also is saying that it will revive in the second half or maybe the last week of June, and there as it moves forward from Maharashtra to about the northwestern part of the country. Then if the monsoon plays out like that, then we see that because of the high base effect of last year and the fact that how the overall broadly normal or above now food inflation would be going below very benign in the second quarter, which is around July, August, and September, because very high base in respect of last year.
Thank you so much for joining us.
Thank you. Thanks.
India's dream run with discounted Russian crude oil is ending. India's goods trade deficit reached a 7-month high of about $24 billion in May, thanks largely to a substantial increase in the oil import bill. Oil imports rose about 28% year-on-year to about $20 billion in May. And one of the reasons for this spike in the oil import bill is expensive Russian oil purchases, which were of course cheaper earlier. Now, India imported roughly 36% of total crude from Russia in volume terms at an imputed cost of $76 a barrel. Iraq and Saudi Arabia, which are the second and third largest source of crude oil imports, accounted for about 36%, which in turn had an imputed cost, or I guess roughly an average cost of $79 per barrel and $90 per barrel respectively, according to an economist from IDFC Bank speaking to Money Control. But the Russian component has been rising. Discounts on Russian crude oil are now only around $2 to $3 a barrel versus about $8 to $10 a barrel last year, according to estimates, and that of course had hit a peak of around $16 a barrel, again according to estimates. So where do we stand now that the dream run, so to speak, is ending, and what does it mean for India's oil basket and bill and beyond? I reached out to Prashant, Vasisht, Senior Vice President and Co-Head of Corporate Ratings at rating agency ICRA, and I began by asking him to take us through the composition of the current oil basket and how Russian oil prices were panning out.
See, currently we are importing quite handsome quantities from Russia. So earlier, whereas Russian crude used to be just a small fraction, less than 1 to 2% only, we are now, I think, about 25 to 30% as Russian procurement as Russian crude. So the discounts in Russian crude have also declined. So these were earlier at about $10 to $16 per barrel that we had seen. And now these are somewhere in the range of about $3 per barrel.
Right. And why have the prices fallen so much? Or rather, why have the discounts fallen so much? Which means we are paying close to what the current Brent crude rate is, I'm assuming.
Yeah, so actually more and more countries are opening up to buy Russian barrels. And that is why the discounts, as the market becomes more widespread for Russian crude, the discounts will tend to reduce and eventually go away. So at the peak when, Europe had just started, sanctioning the Russian crude, to now there has been a lot of other countries that have also started procurement.
Right. So you're saying that at one time we were the only or amongst the major buyers of Russian crude because of sanctions following Russia's invasion of Ukraine. But at this point, there are many countries who are buying, and that's pushing up prices and obviously equalizing it with the market rate for Brent crude.
Yes.
Right. Okay. Now, what does this mean for India's oil import bill? Now, I was looking, for example, at the latest trade deficit, and our import bill has gone up. One reason it's gone up is obviously because the discounts have gone down, and i.e. we're paying more for Russian crude. So what's the basket looking like now?
If you compare last year versus this year, if you remember last year, beginning of last year, that is in April, May, June of 2023, calendar year 2023, the crude prices were in any case quite low, were much lower. So if I look at the Brent crude average price till about June, it was 84 last year, whereas this year it is about 79 till now. So that itself has played to some extent into a higher, import bill. Secondly, because of the general elections, the consumption of petroleum products has also been higher this year, especially in April, May, and June. April and May. June, there has been a slight decline due to the very hot weather. But April, May, during the peak of the elections, there was, increase in the petroleum product consumption. So that has also played into a higher, import of crude as such. For April and May, the year-on-year growth on crude imports is about 2.4%.
So where does this leave India's cumulative import bill, let's say this year versus last year, given that now we are going to be paying, or we have been paying more for crude?
We expect the imports to grow about 3 to 4% for the petroleum products consumption. That would also be the import growth for the crude oil imports also. So that plus whatever is the average crude price for the whole year, that remains to be seen. Third, so that will also play into the
crude import bill. But significantly, since last year, the crude discounts on crude oil of Russian crude were quite down now, are much lower. So I think the import bill may rise by about 10 to 12% this year in FY25 vis-a-vis FY24.
Does this mean that there will be pressure on oil marketing companies to potentially raise prices at the pumps?
Certainly. See, in case the prices increase, the crude prices increase, from the current levels, the crack spreads are also healthy and discounts are lower, negligible or are not there, then marketing companies will have to increase prices because currently, see, there are positive marketing margins on HSD and petrol. But in case all these things happen, which I mentioned earlier, you cannot survive for a very long time with negative marketing margins. So if in a scenario of high crude prices, I think prices may have to be increased in the pump level.
Prashant, thank you so much for joining me.
Thank you for having me. Thanks.
Meanwhile, India's petroleum exports are the top export item when it comes to merchandise trade, to $6.8 billion in May compared to $5.8 billion last year. Overall, exports in areas like engineering goods, electronics, drugs and pharmaceuticals are growing steadily between 7 and 10%. Textiles and within that ready-made garments have been growing too at about 10% on year in May, following a 1% contraction in the last month. So while some of those import numbers are not looking so good, exports are looking reasonably encouraging. However, exports of gems and jewelry and leather products contracted in May. Why homes are lying empty across India? Millions of homes, 11 million to be precise, are lying empty. Now, these are homes that have been purchased by individuals or maybe organizations, mostly for investment purposes. Now, these are distinct from homes that are not sold or lying unsold, which is an interesting figure in itself, and we'll come to that. It also turns out that it is almost cheaper for many people, in a manner of speaking, not to give out a house on rent or lease. There are several reasons for this, but the fact is that this is also artificially boosting housing demand, particularly in the rental space. For example, if there are 10 empty apartments in my corner of Mumbai, of which only 2 are available for rent, it's logical that rentals would be high. Now, while some of these homes may never come into the market, better tenancy laws in many parts of the country could surely offer greater comfort to some of the home owners. The larger challenge, if you want to call it that, of course, is that the bull market in real estate is still strong. Prices are rising so much that owners feel that they're better off with the capital appreciation, even if notional, than trying to earn a rental income with all the attendant problems that they perceive. I reached out to G. Haribabu, National Real Estate Development Council President and Hyderabad-based realtor, and I began by asking him the nagging question: why are homes lying empty?
There are two types of things here. One is unsold flats. Unsold flats, whatever the available with the builder is different. I'm not talking about the unsold inventory stock at all. I'm speaking only the buyers are already purchased. People are having two flats, 3 flats, 4 flats, and they are not interested to give for the lease. They are keeping idle. If somebody goes to that house, who is staying? Nobody is staying. But it is very good apartment and all the things are there. The owner is not interested to give for the lease. These are the apartments. Actually, we have 11.14 million.
And what would be the current, roughly, unsold flat or apartment stock?
Unsold inventory, Mumbai, Maharashtra, I would say. Maharashtra is 2.5 years stock. Other than Hyderabad, remaining Delhi, Ahmedabad, Pune, Chennai, Bengaluru, all these things between 1.1 year to 1.6 years. And Hyderabad is only one city having 4 years stock.
So what does that mean? If there are 4 years of unsold inventory?
4 years stock means presently we are selling about 33,000 flats in Hyderabad per year. Now the stock is almost like 1,22,000.
So which means there are flats that were built 4 years ago which are still to be sold?
No. 4 years stock means 3 years back the stock was only for 1 year, 33,000. But last 3 years, it is adding 40,000, 20,000 like that. No, too many constructions are taking place. Many builders are coming to the picture, new builders, and everybody started constructing huge numbers because market was good from 2016 to 2023. Market is good. Everybody thought they can sell. Demand is for 33,000. Actual construction is almost like 75,000. Who will buy that for buying 40,000? No buyers.
So this is, you're saying, the situation in Hyderabad proper.
So 4 years stock is available. 4 years stock means not the fourth year. Actually, this was constructed only last year, before last year only.
Right, but it'll continue onwards. Okay, to come back to the number of homes that are sold but not occupied, what does that signify? I mean, because people, one, I'm assuming it signifies that there is no rental demand, or there is maybe people who are owning are not comfortable in leasing out and would therefore own it. But what does that tell us? I mean, is there some figure, for example, you say that if it hits this number of so many homes that are sold but not occupied, we are entering, let's say, a peak bull market, for example.
Yeah, but actually, the reason I will tell you. First thing is now why people are not giving for the lease. The income on the flats, rental value is compared to the capital value versus rental value is only 3% in India today. In some cases, even 2.5% to 3%. So when it's coming 2.5%, in addition to that, 21% is the income tax we have to pay on the rental value. So 21% means some amount is going out of, to take 5 years time. That means 1 year money is going for the income tax out of 5 years. In addition to that, local corporation will charge for the property tax. The property tax is also coming almost like 1 month or 1 month, 10 days rental value. At least in the 5 years, they are losing another 6 months for the MCH value. And third thing is, if the tenant is vacating the flat after 5 years, then again, 2 to 3 months, you have to keep it idle and you have to do the renovation. You cannot give it as it is to the new tenant, the old this thing. So the repair cost. All these three things together, that is costing almost 1.5%. So the leftover to the builder is, landowner is only 1.5 or 1.65 maximum. So for 1.5, 1.65, why should he give? That is not for all, but some people are thinking instead of giving for that one, keep it ideal. The value of the appreciation is going up. The market values are going up. The cost of the flat is going up. Construction values are going up. Land cost is going up. So the moment you give for that rent, the value is coming down. If it is completely vacant and it is a fresh new, then the value goes up. That is the one reason. This is the economics I'm talking. Then second one is the model tenancy agreement has come into the picture for the last 3 years. Actually, the NAREDCO has pursued with the Government of India, and the Government of India has issued Model Tenancy Act. Now, the major problem is that Maharashtra, Tenancy Act is more favorable to the tenant, not to the landlord. So, if the Maharashtra government or Gujarat or this, say, out of 29 states, only 4 states implemented the Model Tenancy Act. The 4 states are Assam, Andhra Pradesh, Tamil Nadu, and UP. Remaining states and remaining area place, they are not implemented the project thing. In the absence of model tenancy agreement, vacating the tenant also becomes very difficult. And today, if somebody want to ask the tenant to go, if he is not paying the rent also, he has to file a case. The biggest problem is in India, the ease of doing business particularly is very slow in the legal side. A commercial legal case will take 1445 days average. That means it takes about 4 years to resolve that problem in the court of the law.
And make it unviable to lease out. Yeah. So if I were to come back to, you said that today at this point of time, owners find it much more, let's say, lucrative to hold on and then wait for the capital appreciation, because there is capital appreciation and has been in recent years. But if you look back at in your own experience as a real estate developer and builder, it's a cycle. I mean, at some point it has to, because you have so much of buying, people are not, putting those assets to use. And obviously capital appreciation may not happen consistently and forever. So what's your sense?
Yeah, agreed. But if you look at from last 20 years, see, if you look at the gap, downstock, there will be up and down will be there. But every 5 years, there is a appreciation, and 2-3 years, it will be flat, and again, it starts appreciating. But if you look at the 20 years of the total life of the apartment, in 20 years, now, if you look at the 20 years graph, it is always more than 5%, 6% appreciation. That means in 2001, an apartment is available in Mumbai, and 2024 today available in Mumbai. It is almost like, if you compare now, more than 5%. Sometimes some places it is 7%, 8% appreciation there. Because land costs are increasing almost like 20%, 15 to 20%. Construction cost is increasing by 5%. Because general inflation itself, near inflation itself, between 5 to 6%. So 5 to 6% inflation means that appreciation will be there.
So you're saying the value of the house has gone up by how much then in the last 20 years on an average?
Cumulative 6% minimum.
For 6% per annum. Okay, so that's compounded annual. Okay. So you're saying that since we've seen a 20-year bull run, it's therefore likely to continue for longer, or?
Yeah, and longer. Not only that, the urban population is increasing. See, another biggest thing is our urban population is increasing every year. So the increase is almost between the cities 2 to 2.75%, even 3%. Hyderabad is almost touching 3% per annum. And that means today we have 1.4 crores population in Hyderabad. That means by next year, that will be more than 144 lakhs. So 4 lakhs population is increasing. So that's also that demand is there and that much growth is there. So land, as long as the land cost is increasing by 15%, every apartment, every flat has to go up. See, they are not bothered about this 1.5% of the yield, then the appreciation. So, okay, it is like my second home. Whenever I go up, I go and stay, or my guests will come, they stay for some time. But this 1.5%, and why should I go to the court of the law and getting all these things? See, that is the reason my first recommendation is implement the Model Tenancy Act. Model Tenancy Act. Every state has to implement. Why the central government has bought the act? Seeing all these problems only, they bought the act. But the state government is not implementing. If they start implementing, then the agreement should be by registered agreement. If the gentleman specific period, if the flat is given for 60 months, and 61 month, if it doesn't vacate, the rent will go to double.
What's your outlook for the industry, particularly at, let's say, mid-market, not luxury or premium, but mid-market, particularly in the next year or so?
That market is growing tremendously. That is luxury, super luxury, and houses. The flats are nowadays is becoming bigger and bigger, and the 3-bedroom used to be about 2,000 square feet, but today the 3-bedroom people are constructing a 3,000 square feet. It means that they want bigger areas, bigger bathrooms, and bigger this thing, and home theaters, etc. But if you come into for economically weaker sections and the lower income group people, only they are depending on only completely 100% free from the state and central government budgets. They want land as free and they want some incentives, so then they need some concessions in the registrations, etc. So EWS, most of the state governments are taking care of with the Pradhan Mantri Awas Yojana. This year, Pradhan Mantri Awas Yojana already declared about 3 crore homes. 2 crores goes to the rural, 1 crore goes to the urban. So EWS people, they are comfortable with the government, what they are giving. High net worth people, they are having no problem because they have a lot of funds with them. The biggest problem comes to the lower middle income group. Lower middle income group means either government is taking care of them or not the builders are taking care of them. So for them, lower middle income group means people who are drawing the salaries in urban, 50,000 rupees to 1 lakh. A person, a joint family, husband and wife together, earning 50,000, where is the budget for them to buy today? Their budget is available only 50,000 rupees CMI they can pay. That 15,000 rupees CMI, they are eligible for only 15 lakhs today. With 15 lakhs loan and 5 lakhs of their own, 20 lakhs, where can I get? Even I think even 1 room is not possible. So that is the biggest problem. That is the biggest challenge. That is the reason in urban, 35% of the lower middle income group people and middle income group people are not able to buy. That means the real affordable housing for them is not taking place. Yes, 7 years back when affordable housing scheme was announced, that time the land costs are not this much. For example, Hyderabad, that time land cost was about 20-25 crores. Today, the same place, same area, government auction, it has gone to 100 crores. Another thing is in 7 years, there is a 5 to 6% increase in the raw material cost. In addition to that, majority cost has come in the labor. Labor is almost like 40% increase in the labor cost because inflation is taking place too much. So the biggest loser is that particular segment.
Right, Mr. Babu, thank you so much for joining me.
Thank you.
That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.